As we move forward, in the next chapter, we'll deep dive into the typical FP and a monthly calendar. Chapter 6, the FP and a monthly calendar. Monthly calendar, the FP and a calendar is a critical tool that helps finance professionals stay organized. Why is it important to have an FP and a calendar? Effective FP&A requires a structured and disciplined approach to managing FP&A activities. Having a well-defined calendar enables the team to anticipate upcoming tasks, plan ahead, and allocate resources effectively in order to optimize performance. It also helps to track the tasks and plan for upcoming deadlines. This is where the FP and a monthly calendar comes in handy. This chapter will detail the typical monthly activities in an FP and a calendar, highlighting the importance of each phase in the monthly cycle. By understanding these regular tasks, FP&A teams and different stakeholders can ensure that they meet important deadlines. Points to remember before we get into the FP and a calendar. 1. FP and a calendar is a best practice calendar and not standard or a rule. The FP and a monthly calendar presented in this chapter represents a compilation of best practices rather than strict rules. It's important to understand that the specific activities and their timing can vary significantly. They depend on various factors such as the industry, the age and size of the company, and the maturity of the FP and a team. This calendar serves as a guideline that can be adapted to fit the unique needs of different organizations. Industry-wide variations. Technology startup in a fast-paced tech startup. The FP and a monthly calendar might focus more on cash flow management and rapid forecasting. Updates due to the high rate of change in the technology sector. The team might need weekly forecasting cycles to adjust to market dynamics quickly. Manufacturing firm. For a mature manufacturing company, the FP&A calendar may emphasize cost analysis and efficiency metrics, with less frequent updates, but deeper dives into variance analysis and capital expenditure planning due to the capital-intensive nature of the industry. Company age. New company. A newly established company might not have established all formal processes. So, the FP and a calendar could be more fluid, focusing on establishing baseline financial systems, setting up initial budgeting processes, and managing startup costs. Established company. An older, more established company likely has a more structured FP&A calendar. That includes detailed and standardized processes for everything from reporting to analysis, reflecting the stability and predictability of their business operations. FP and a team maturity. Developing FP and a team in a company where the FP and a function is still developing. The calendar might initially focus heavily on basic tasks such as managing the month-end close process and basic reporting. As the team matures, more sophisticated activities like ad hoc analysis and strategic advisory roles might gradually be integrated. Mature FP&A team. A mature FP&A team in a large multinational might have a highly complex monthly calendar that integrates advanced analytics, detailed scenario planning, and strategic involvement in corporate decision-making, reflecting the team's advanced capabilities and strategic importance to the organization. 2. Calendar month structure. For clarity and simplicity, the calendar is organized by weeks within a typical month. For example, week 1 starts on calendar day 1 and ends on calendar day 7, and so forth. This structure helps standardize the discussion around when tasks typically occur but should be adjusted according to the actual number of days in each month and specific business schedules. Also, note we review prior month numbers in the current month calendar. It is standard practice to review the financial numbers from the previous month during the current month. For example, if we are currently in the month of April, the FP&A team will be reviewing and analyzing the financial results from March. 3. Exclusion of annual budgeting process. Note that the activities described in the FP and a monthly calendar exclude the annual budgeting process. Budgeting is a separate, comprehensive process that involves extensive planning and coordination and occurs once a year. The monthly calendar focuses instead on the recurring tasks that support the continuous financial management cycle every month. To summarize, remember the FP and a calendar is best practice and not a rule or a standard, and varies based on company size, industry, age of the company, and age of the FP in a team. Talks about the previous month's numbers, performance. Doesn't talk about the budget. Overview of the FP and a monthly calendar. Week 1. Begin with the accounting close process, which involves consolidating and finalizing the financial data for the previous month. This phase includes generating flash reports and other key financial summaries that provide a snapshot of the company's financial health. The preparation of management reports follows, which are detailed documents that provide insights into financial performance, key metrics, and variances from the budget. Week 2. Forecast updates and business reviews. Update preliminary forecasts based on recent performance and any new business developments. This often involves revising financial projections and assumptions to reflect current market conditions and business realities. Conduct business reviews with department heads to discuss the results, update forecasts, and gather feedback that will inform the next planning cycle. Week 3. Special projects and strategic initiatives. Focus on any special projects or strategic initiatives that require financial analysis and support. This could include profitability analysis, cost reduction initiatives, or investment appraisals. This period may also involve preparing for any upcoming strategic meetings or presentations to the board or executive team. Week 4. Preparation for the month end and week 1 of next month. The final week of the month is typically used to prepare for the upcoming month. This includes setting up tasks, aligning resources, and ensuring that the FP&A team is ready to handle the next month's activities efficiently. In the remaining part of this chapter, we'll provide a comprehensive look at the essential activities that comprise the FP and a monthly calendar. Comprehensive tasks week-wise. Week 1. Accounting close and management reports. Flash reports. Flash reports are summaries designed to provide a quick snapshot of a company's performance well before the detailed month-end reports are finalized. These reports are crucial for senior management who need immediate insights to make timely decisions. Rather than waiting until all financial books are closed and comprehensive reports are ready by the end of week 1 or later, these reports serve as an early indicator of financial results and trends, enabling senior management to react quickly. They provide early warning signs of unexpected results, whether positive or negative, allowing management to respond promptly. Make timely decisions. Flash reports help executives make informed decisions rapidly, without waiting for the full details that come later in the financial cycle. Monitor vital metrics. They focus on key financial metrics such as revenue, expenses, and cash flow, offering a quick health check on these critical areas. Key characteristics of flash reporting. Speed. Flash reports are prepared very quickly after a period ends, often within the first few days of the month. Simplicity. They typically include only the most critical financial data, avoiding the complexity of full financial statements. Frequency. Because they are designed to be prepared and distributed quickly, they can be issued more frequently, often weekly, or sometimes even daily, depending on the company's needs. Example, a retail company starts a big sale in the middle of a month. Management could use a flash report to quickly see the initial impact of the sale on revenue and profits, without waiting for the detailed monthly reports. This early data allows them to adjust marketing strategies or inventory orders based on actual sales performance. In summary, flash reports act as a high-level early glimpse, providing essential data to senior management at a speed that matches the pace of decision-making. They are a brief summary of financial data and key performance indicators (KPIs) that provide a snapshot of a company's financial health and performance. They cover a specific period, a day, week, or month, and are prepared quickly to provide timely insights. Focuses on the most critical information and highlights any significant changes or trends. A way to keep decision makers updated on the financial performance and enable them to make informed decisions based on the current state of the business. They bridge the gap between month-end reports, month close, and accounting reviews. Month close is a process that ensures that all financial transactions for that period are recorded accurately and completely. FP&A assists the accounting team in a smooth month-end close. BVA stands for Budget Variance Analysis and helps assess how well the company's actual financial results align with the budgeted expectations. It involves comparing the budgeted revenues, expenses, and other financial metrics with the actual figures and analyzing the variances. Focuses on the most critical information and highlights any significant changes or trends. Month-end reporting packs with commentaries. Detailed overview of the company's financial performance, key metrics, and other relevant information for that month, typically distributed to senior management to keep them informed about the financial health of the organization. Here, the actual results from last month are compared to both the budget and the most up-to-date forecast. It contains variance analysis, business commentary, and recommendations. Here is a snapshot from a company's month-end reporting slide. Quarter-end reports, quarterly business review deck. Discusses highlights, lowlights, and key learnings from the previous quarter. Provide a detailed overview of significant risks, opportunities, action plans, OKRs or targets, and forecast for the next quarter. Identifies adjustments that need to be made in the next quarter based on previous quarter's performance. To summarize during the first week, FP and a focus lies on accounting close and management reports. It covers flash reports, month close and accounting reviews, month-end reporting packs with commentaries, and quarter-end reports. Next, let's move to Week 2. Week 2, forecasting. Week 2 is all about forecasting. Here are the 5 steps. Step 1. FP&A updates prelim forecasts. The forecast cycle starts with FP and a reviewing historical performance, assessing current trends, and considering any external factors that may impact the forecast. The FP and a team incorporates this information into the preliminary forecast. Step 2. FP and a reviews forecast with business teams. Collaboration with key business teams is vital for accurate forecasting. The FP and a team engages with department heads, sales teams, marketing teams, and other relevant stakeholders to gather their inputs and insights. This collaborative effort ensures that the forecast aligns with the operational realities of the business. The FP and a team incorporates feedback from these teams and refines the forecast accordingly. Step 3. FP and a reviews forecast with CFO. The FP and a team presents the forecast, discusses key assumptions, and seeks input from the CFO. The CFO provides valuable insights, challenges assumptions, and ensures the forecast is in line with the organization's financial goals and objectives. Step 4. Upload lock forecast in the system. Once the forecast is finalized, it is uploaded into the designated financial planning system. Uploading the forecast into a centralized system facilitates easy access, data consolidation, and automated reporting. To maintain consistency and integrity, it is crucial to lock the current forecast once it has been uploaded into the system. This ensures that the forecast remains unchanged, preventing inadvertent modifications that could compromise accuracy. Locking in the forecast also establishes a clear baseline for tracking performance and enables effective comparison with actual results. Month-end, quarter-end business reviews, MBRs and QBRs. These meetings bring together FP&A and business stakeholders to review the financial performance, discuss variances, and gain insights into the factors driving the results. Month-end reviews involve analyzing the financial results for a specific month, including revenue, expenses, and other key financial metrics. Quarter-end reviews are more comprehensive and encompass the entire 3-month period. Week 3, a time for strategic focus and preparation. Week 3 stands out as a period that typically carries a lighter workload compared to the intense activities in weeks 1, 2, and 4. It provides a valuable opportunity for the FP and a team to plan for leaves. Given the less demanding nature of this week, team members often find it an ideal time to schedule leaves. This planning ensures that the team remains well-rested and effective, particularly important in managing the more intense demands of the closing and reporting periods. Focus on special projects. With a routine financial task under less pressure, Week 3 is an excellent time for the FP and a team to dive into special projects. These projects might include strategic initiatives such as exploring new investment opportunities, conducting detailed profitability analysis, or developing new financial models that will drive future growth. Advanced automation efforts. Leveraging the relatively quieter period, efforts to enhance efficiency through automation can be prioritized. This could involve upgrading financial software, streamlining data collection processes, or implementing new tools that reduce manual effort and improve accuracy. Preparation for next month. Week 3 also allows the team to begin preparations for the upcoming month. This includes setting up frameworks for the next cycle of reporting, forecasting, and analysis, ensuring that the team is well prepared to handle the forthcoming tasks efficiently. By using Week 3 strategically, FP&A teams can ensure that they not only maintain ongoing operations smoothly, but also enhance their strategic capabilities and readiness for future challenges. Here are some common tasks during this period. 1. Recharges and allocations. Recharges involve transferring costs incurred by one department or entity to another within the same organization. Allocations are used to distribute costs across different departments or cost centers based on predefined allocation methods. A way of assigning shared costs to various entities or business units based on predetermined criteria, such as the proportion of usage, headcount, revenue, etc. Both recharges and allocations are important tools for accurately assigning costs within an organization, enabling better cost visibility and accountability. 2. Profitability analysis provides insights into the most profitable aspects of the business and guides decision-making to maximize profitability. Examples: BU-wise profitability, branch profitability, customer-wise profitability, project-wise profitability, country-wise profitability, etc. 3. Working capital management. Monitor and optimize the company's short-term liquidity and operational efficiency if there is no separate treasury team. Ensure that the company has enough cash and resources to support its day-to-day operations while minimizing unnecessary costs tied up in working capital. Activities, cash flow forecasting, working capital efficiency initiatives, etc. 4. Automation. By automating repetitive tasks, improving data accuracy, and enabling efficient analysis, and by embracing automation, FP&A teams can focus more on value-added activities and provide timely insights to drive strategic decision-making. 5. Special projects and supporting the business. FP&A plays a vital role in special cross-functional projects by providing financial analysis, budgeting, forecasting, and decision support. Their involvement ensures that projects are financially viable, align with strategic goals, and are effectively managed from a financial perspective throughout their life cycle. 6. Risk and opportunities assessment. By actively assessing risks and opportunities, FP&A helps organizations make informed decisions to mitigate risks, exploit opportunities, and improve financial performance. Week 4, month-end close and preparation for Week 1. 1. Flash reports revenues, expenses. Flash reporting, which we saw at the beginning of Week 1 earlier in this chapter, typically starts at the end of the month, even before the actual financial data for that period is fully available. They contain preliminary data that offer an initial evaluation of financial performance. They serve as a foundation for further analysis and reporting when the actual data is accessible. 2. Revenue close. Revenue close is the process of finalizing and accurately recording revenue-related transactions and activities within an organization. FP&A collaborates with the accounting department to validate the accuracy and completeness of revenue-related data. 3. Accounts payable close, accruals, prepaid JVs. FP&A assists in the process of identifying and calculating accruals for expenses that are applicable to the current accounting period, but have not yet been billed or paid. Prepaid expenses are advance payments made by a company for goods or services that will be utilized in the future. FP&A assists accounting in accurately recording and managing these prepayments. This chapter has systematically explored the FP&A monthly calendar. a fundamental framework that guides the activities of FP&A teams. Each week of the calendar is meticulously planned to ensure comprehensive management of tasks, from the closing of books and preparation of management reports to strategic reviews and preparation for upcoming challenges. We began with Week 1, where the focus is on closing the previous month's accounts and generating initial financial reports. This sets the stage for Week 2, which involves deep dives into financial forecasting and performance reviews, essential for adjusting strategies in real time. Week 3 offers a lighter schedule, allowing teams to focus on special projects, automation enhancements, and strategic planning without the pressure of immediate deadlines. Finally, Week 4 wraps up the month with preparations for the next cycle, ensuring a smooth transition and readiness for new challenges. Quick recap of the FP&A calendar. Week 1, accounting close and management reporting. Week 2, forecasting and business reviews. Week 3, other items, special projects and automation. Week 4, month-end close and preparation for week. As we conclude this chapter, it is clear that the FP&A monthly calendar is not just a schedule, but a strategic tool that enables FP&A teams to operate efficiently. The insights garnered here will serve as a foundation for your FP&A career. Preparation is key in FP&A. Up next, we will discuss how you can prepare effectively for your first or the next FP&A role.